case study number one is about the value of having a financial advisor that is overlooking your tax return. And that's what happened in this scenario. We had a client who came in and they had an investment that they were selling after a long period of time, and they were selling it for a profit. Now, we've talked about capital gains on this podcast, and you know that if you have held an investment for at least a year and a day, you pay long-term capital gains taxes on that sale, which are either 0, in most cases 15%. If you're a really high income earner, you pay 20% on long-term capital gains. Now, when it comes to capital gains in a tax return, they are listed on Schedule D of your tax return. It's an additional form for your 1040 that lists the details of what was sold and what the profit was of that sale. And that profit is taken over to your 1040 so that you can see what you pay taxes on. Well, we had been talking to this client about selling this investment for over a year. So we were acutely aware of the value of the investment before it was sold and also their cost basis. Cost basis is a client's skin in the game. It is essentially what allows the IRS to determine what is profit when something is sold and what is simply a return of the owner's capital. So for example, if you sell something for $150,000, but you put $50,000 into it, well, when you sell it, that's not all profit. $50,000 is a return of your cost basis, and you have $100,000 of profit. So because we were well aware of the market price of the investment and also the investor's cost basis, when we reviewed their tax return that had already been filed, we noticed that the CPA had doubled the investor's profit and had not considered their full cost basis when calculating what was shown on their 1040. Now, the client was upset because they had a tax return that led to a bigger payment than they were expecting on that sale. And we were able to go to them and say, hey, we think there's been an error here. Go back to your CPA and give them this information and make sure that they accurately listed your profit. And when they went back to their CPA, they found out that yes, indeed, they had actually double counted the profit, and it led to a 5-figure return when that CPA amended what they had filed for the client. This is just one example of us not being tax professionals, but having enough knowledge of both a tax return and our client's situation by meeting with them several times a year to be able to tell them to go back to their CPA and ask for them to assess this situation.